if you look at the landscape of the tech sector right now, uh, it feels exactly like we are watching four titans build the world's most aggressively expensive casinos.
Well, absolutely.
Right, because for the past year, I mean, everyone has just been buying up the real estate, ordering the high-end slot machines, laying down the plush carpets. But today, the Q1 2026 numbers just dropped.
Yeah, the real numbers.
Exactly. We spent the entire morning tearing through this massive stack of earnings reports, Wall Street analyst notes, post-market tech sheets, and our mission for you today, the listener, is to act as your personal hedge fund analysts.
Right, we're cutting the fluff.
We are entirely bypassing the generic headlines. We're here to dissect the massive divergence in how the market treated Meta, Google, Amazon, and Microsoft today. Because these numbers, they finally reveal who actually has gamblers walking through the casino doors and who is just bleeding cash on endless construction.
The tension dominating the market right now is, frankly, it's palpable. I mean, we are looking at the ultimate showdown here, the AI Capex race versus actual monetization. Hundreds of billions of dollars are being deployed across these four companies, but Wall Street is getting ruthless. They are no longer rewarding the mere promise of artificial intelligence.
No, the free ride is over.
It's totally over. They are actively separating the infrastructure builders who are creating structural monopolies from the companies that are, just footing the bill for the hype.
Well, I want to start by looking at the very foundation of this build-out. Because to understand who is actually winning the AI monetization race, we have to look at the quarter's biggest shocker. A company the market practically left for dead in the AI race just 12 months ago, Alphabet.
Yeah, the consensus on Alphabet was incredibly bearish this time last year. I mean, the prevailing narrative was that Google is purely an advertising company desperately trying to defend its core search business from generative AI chatbots.
Right.
But this quarter completely shattered that thesis.
Let's put the actual numbers on the table to show why. So total revenue came in at $109.9 billion, which is up 22% year over year. But I want to stop you right there because there is a number buried in this report that I think completely destroys the bear case.
The cloud number.
Yes, the cloud number. Google Cloud hit $20.03 billion in revenue, up a massive 63% year over year. And more importantly, and this is the kicker, their cloud backlog nearly doubled to over $460 billion.
Right, and we need to pause and actually define what that backlog number means because retail investors often gloss over it.
They just see backlog and think, oh, it's a projection.
Exactly. But a backlog isn't just a projection. It is legally committed contract money that has not yet been recognized as revenue. When you have nearly $500 billion in backlog, you aren't just selling basic server storage anymore. You are locking in future AI enterprise revenue at a scale that fundamentally changes your valuation model.
Wow.
You are becoming the foundational AI operating layer for the Fortune 500.
So if we bring this back to our casino metaphor, Google isn't just operating the games. They're like locking the biggest whales in the world into multi-year contracts to use their specific VIP rooms.
Yeah, that's exactly it.
But processing $500 billion in enterprise AI workloads, I mean, that requires an airtight vault. Which brings us to the $32 billion acquisition of the cloud security firm Wiz that closed back in March. A lot of analysts called that an overly expensive bolt-on.
Calling it a bolt-on completely misunderstands the mechanics of enterprise cloud. Look, if a massive bank or a healthcare provider is going to commit billions to Google's AI infrastructure, they demand military-grade, native cloud security. The Wiz acquisition is the mandatory security architecture required to digest that $460 billion pipeline.
Right. You can't have the backlog without the vault.
Precisely. The broader market is still obsessing over whether everyday consumers are using AI overviews instead of traditional Google search. But the real alpha, the massive sticky revenue, is sitting right there in the enterprise security and cloud pipeline.
Okay, I hear the bullishness, but my job is to scrutinize the entire board, so I have to bring up the singular miss in Alphabet's report.
Go for it.
YouTube ads. They came in at $9.88 billion versus a $9.97 billion consensus estimate. If we are intellectually honest here, doesn't a miss in one of their highest margin ad platforms signal a crack in the foundation, especially when they're spending so heavily on AI?
I view the YouTube miss as rounding error noise in the grand scheme of a multi-year Capex cycle.
Really? Just noise.
Yeah, I mean, you have to weigh a slight ad miss against the forward indicators of actual AI monetization. Look at the operational milestones in this print. Gemini Enterprise paid monthly active users are up 40% quarter over quarter.
Right.
Waymo is executing 500,000 fully autonomous rides every single week. They raised their dividend by 5%. The stock popped 6% after hours because institutional money realized Google isn't playing defense anymore. They're aggressively expanding their moat.
Okay, so Google is clearly dominating the digital contracts and the security side. They're effectively selling the highest-end software, picks and shovels. But none of that software matters if you can't physically plug it into a wall.
Right, the physical constraints.
Exactly. You can't run a digital casino without electricity and the actual physical hardware. And that brings us to the physical constraints of this race, where the market completely misread what Amazon is building. Because the reaction to Amazon's print was fascinating and, honestly, highly contradictory.
It was a textbook case of the market entirely misreading a hardware pivot. I mean, Amazon printed incredible operating efficiency. Their operating margin hit 13.1% on $181.5 billion in revenue.
Which is huge for them.
Massive. AWS alone hit $37.6 billion, up 28% year over year, which puts them at a $150 billion AI revenue run rate. Yet the stock sold off after hours.
Yeah, but if you're sitting at home looking at Amazon's $200 billion infrastructure bill, your first instinct is probably to hit the sell button, too.
Sure.
I mean, they spent $44 billion on capital expenditures in Q1 alone, and they are pacing for around $200 billion in total Capex for 2026. Retail investors saw flat retail margins combined with a terrifying infrastructure bill and just panicked.
And that panic is exactly where the contrarian edge lies for the informed investor. What the sellers are missing is the custom silicon advantage.
Unpack that a bit.
Look, the entire industry has been bottlenecked by NVIDIA. If you want to train an AI model, you have to pay NVIDIA's massive premium for their GPUs. But Amazon is successfully bypassing that bottleneck. They're deploying their own custom chips, Trainium and Graviton, at an unprecedented scale.
Right.
In fact, over half of the 2.1 million AI chips Amazon deployed over the past 12 months were their own custom Trainium chips.
Which means they are essentially manufacturing their own casino chips and slot machines instead of paying a third-party markup to NVIDIA.
Exactly.
And the revenue run rate for those custom chips is now over $20 billion, growing in triple digits. That isn't just cost savings. It is a massive new revenue stream.
Let's take that a step further into the physics of AI, because it goes far deeper than just the silicon. OpenAI just committed to 2 gigawatts of Trainium capacity.
2 gigawatts?
Yeah, and Anthropic secured up to 5 gigawatts. We need to frame what a gigawatt actually means. We are talking about the power required to run entire cities.
Right.
Amazon isn't just a cloud host renting out server space anymore. By locking in OpenAI and Anthropic to these massive, power-hungry contracts, Amazon is becoming the foundational power grid of artificial intelligence.
I want to make sure the mechanics of this are crystal clear for you listening. Amazon is effectively telling the market, we're designing the custom engines, and we literally own the physical power grid that the most advanced AI companies on Earth are forced to plug into. Under that lens, spending $44 billion in a single quarter isn't a sunk cost. It's building an impenetrable physical moat.
Precisely the right framework. This expands Amazon's structural margins over time because they control the entire stack from the silicon design down to the cooling and the power deployment. Furthermore, OpenAI's GPT 5.4 is now available directly on Amazon Bedrock.
Wow.
Yeah, they're securing both the physical supply chain and the software distribution. Selling off the stock because of a $200 billion Capex plan is a fundamental mispricing of what that money actually buys you in 2026.
So Amazon is spending its way to a hardware moat, absorbing that short-term hit to investor sentiment. But what if a company could spend massively on infrastructure while simultaneously proving to Wall Street that they can pull the margin lever?
That's the dream.
Right, and that is the exact tightrope Microsoft walked this quarter, and they delivered an absolute masterclass in cloud accounting.
Oh, Microsoft's quarter was a stunning reversal of sentiment. We have to remember the context here. Just last quarter, Microsoft suffered a historic $357 billion single-day market cap crash simply because their capital expenditure guidance terrified the market.
It was a bloodbath.
It was. But this quarter, they completely flipped the script.
The underlying numbers here are incredibly tight. Revenue was $82.9 billion, up 18%. Azure and other cloud services were up 39% in constant currency, which comfortably beat their own 37% to 38% guidance.
Right.
Their total AI annual revenue run rate surpassed $37 billion. But the absolute kicker, the metric that made analysts sit up in their chairs, was the capital expenditure. Capex came in at $31.9 billion. That is a massive $3.4 billion below Wall Street estimates.
And this is where we have to challenge the prevailing narrative again. The headline readers were obsessing over Azure's top-line growth hitting that 39% mark. But the real alpha, the detail that fundamentally shifts Microsoft's profitability going forward, is buried in the OpenAI contract restructure that finalized on April 27th.
I want to dig deeply into that April 27th restructure because the financial engineering behind it is basically the skeleton key to their margin expansion.
It really is.
So the licensing shifted to non-exclusive, but the true masterstroke is that Microsoft eliminated outbound revenue share payments to OpenAI through 2032.
Let's break down exactly how that works for the listener. Previously, every time Microsoft sold an AI service powered by OpenAI's models, a percentage of that revenue had to be kicked back to OpenAI.
Right, an outbound payment.
Exactly. By eliminating those outbound payments, Microsoft is taking a massive liability off their balance sheet. Every single dollar of Azure AI revenue now drops straight down to their growth margin.
Incredible.
They don't have to deploy a single new server to make more money. They just keep a significantly higher percentage of the revenue they're already generating.
So to clarify the operational leverage here, Microsoft is spending $3.4 billion less on Capex than Wall Street projected, yet Azure is actually growing faster than guided at 39%.
Yes.
Meaning they have essentially cracked the code on making AI compute highly profitable today rather than treating it as a massive sunk cost for some distant future.
That is the exact signal they are sending. They are proving that underlying AI demand is capacity constrained. They could easily sell more compute if they had the physical data centers built. Yet, despite that intense demand, they still managed to rein in the infrastructure spending and expand their gross margins.
Optimization.
Exactly. They are moving out of the sheer panic of the initial AI build-out phase and entering a highly disciplined, hyper-profitable optimization phase. The house is optimizing its payout ratios.
Microsoft gets rewarded for showing Capex discipline and gross margin expansion. And that sets up the ultimate contrast for the final tech giant on our desk today. Because while Microsoft proved you can be disciplined, Meta just stepped on the Capex gas pedal with both feet.
Oh, they floored it.
They floored it, and Wall Street punished them severely for it.
Meta's core business is printing cash through AI-driven ad efficiency. That is an undeniable fact of their balance sheet. But Wall Street threw an absolute tantrum over their increased infrastructure spending and stalling user growth. The stock tanked 5% to 7% after hours.
Let's look at the mechanics of why that tantrum happened. Meta raised their 2026 Capex guidance to a massive range of $125 billion to $145 billion.
Huge numbers.
Right. And at the exact same time, daily active people, which has historically been their core user metric, saw a slight sequential decline. They attributed that drop to internet disruptions in Iran and Russia. But when you combine a shrinking user base with the ballooning infrastructure bill, the market's knee-jerk reaction is to sell.
But that sell-off is rooted in a highly flawed legacy framework.
How so?
Investors are still hyper-focusing on user growth. The contrarian reality is that user growth is a legacy metric for Meta right now. They do not need to add 1 billion new users if artificial intelligence makes their existing users infinitely more monetizable.
Right. If we go back to the casino, Meta doesn't need more people walking through the door. They are comping drinks and using AI to figure out exactly how to keep the current gamblers at the slot machines longer, extracting more value per spin.
Look at the actual ad delivery data to see that in action. Ad impressions were up 19%, but the average price per ad increased by 12%.
That's real pricing power.
It is, and that pricing power is directly driven by AI integration into their ad delivery system. Their value optimization suite now has a revenue run rate of over $20 billion. The AI is so good at targeting that advertisers are willingly paying 12% more for the exact same ad slot. That AI machine is what drove total revenue up 33% to $56.3 billion.
But as analysts, we have to maintain our intellectual honesty and scrutinize the bottom line here. You mentioned the top line revenue, but the headline net income was up 61%.
Right.
Which looks absolutely incredible until you read the fine print in the SEC filings. That net income was heavily padded by an $8.03 billion one-time tax benefit. Without that benefit, their tax rate would have been 14% rather than negative 23%.
Yeah, it's a massive swing.
So the hard question we have to ask is Meta's underlying operating profit actually strong enough to keep up with a $145 billion Capex bill? Especially when Reality Labs is still burning over $4 billion every single quarter.
It is a totally valid pushback, and you have to normalize for that tax rate. Yes, the tax benefit artificially flattered the bottom line, but if you strip out the noise of that one-time event, you are still left with $12.4 billion in pure free cash flow for the quarter and a 41% operating margin.
41% is still massive.
Exactly. The core family of apps, Facebook, Instagram, WhatsApp, is functioning as a massively efficient economic engine. It is absolutely strong enough to subsidize Mark Zuckerberg's aggressive data center build-out, even with the metaverse operating as a $4 billion anchor. The AI ad pricing power is real, and it is more than covering the spread of their spending.
So what does this all mean when we zoom out and look at the entire board? Let's synthesize the mechanics of what we've uncovered today. We have Google emerging as the surprise enterprise cloud titan, locking in $500 billion in backlog and the security infrastructure to defend it.
Right.
We have Amazon aggressively monopolizing the physical layer, the custom silicon, and the literal gigawatt power grid. We have Microsoft proving that through brilliant cloud accounting and contract restructuring, AI can be a highly profitable, high-margin business right now.
Today.
Right, today. And we have Meta daring the market to bet against its AI ad pricing power, proving they can extract massive yields from a mature user base.
If you remember one thing from this deep dive, it must be this. The market is currently mispricing infrastructure as a liability. Short-term investors are getting spooked by the sheer size of the Capex numbers.
The sticker shock.
Exactly, but the companies building the custom silicon, securing the power grids, and expanding their cloud backlogs today are effectively establishing the toll booths for the entire future of the global economy. Do not let a post-earnings, after-hours sell-off distract you from the multi-gigawatt utility contracts and enterprise security frameworks being locked in behind the scenes.
The toll booths are absolutely being built and the foundation is poured. But I want to leave you with one final thought to mull over, pulling it all back to our casino metaphor one last time. All four of these tech giants are spending hundreds of billions to build the infrastructure for the next decade. But look at the subtle shifts in the alliances. With Microsoft dropping its exclusive revenue share with OpenAI and Amazon simultaneously locking up OpenAI on its Bedrock platform with GPT 5.4, are we witnessing the quiet end of exclusive AI partnerships? Are we seeing the beginning of a brutal open market price war for compute, where every casino has the exact same slot machines on the floor? Keep a very close eye on those data center power bills, because in the next phase of this race, whoever controls the grid controls the entire game.